What's up, you guys? It's Leo here. Welcome back to the channel. So you want to buy a house. Currently I'm located in Florida and the average cost of a house is $400,000. So most people will tell you you need 20% down plus closing costs. That's around $85,000 to $90,000. Most people don't have that type of money. So how do you get into an average home in Florida, for example, or anywhere in your market if you don't have 20% or 25% down? How do you do it? Well, today we're going to talk about 4 different loan types, okay? Primary residence, secondary residence, vacation homes, and investment property. Very important that you match the correct loan with the correct house, okay? Let's get into it. Alright guys, so primary residence. This is going to be your lowest cost, best way of getting in a house. This is why people do what's called house hacking, which I'm going to talk about later on. But if you buy a house as a primary residence, you get the best terms available. For example, there's the FHA loan. The FHA loan is a government loan that allows you to get into a home with 3.5% down. So in our scenario, $400,000 for an average home in Florida, 3.5% down is just about 15 or so, 15, 16 grand. So it's pretty affordable versus having to put 80 to 85 grand, when you account for closing costs. The negative part of the FHA loan is that if you put less than 20% down, you have to pay what's called mortgage insurance. Usually, I'm going to tell you how to avoid mortgage insurance. But if you put less than 20% down on an FHA loan, typically there's mortgage insurance. And on FHA loans, usually mortgage insurance is higher than regular loans because people tend to view FHA loans because it's such a lower down payment. By people, I mean banks tends to view it as a little bit more risky. So mortgage insurance on a $400,000 house where the bank is letting you borrow $380 or so, mortgage insurance can be $300-400 a month. And that's money you never get back. It doesn't go towards your principal, it's just fees, okay? It's like fees. It protects the bank until you have enough skin in the game per se. So that's significant. Well, how do you avoid mortgage insurance and not put 20% down, put less than 20% down? Well, those are the specialty loans, okay? The specialty loans are under the primary residence loans. And those are loans like similar to what I have for my primary residence here, which is a doctor's loan, okay? Certain banks will define what they consider as a candidate differently. For me, I have a doctorate degree in nursing anesthesia, and so this is how I qualified for it. Some banks, if you're a pharmacist, some banks I've heard even if you're a registered nurse, you can still qualify for a doctor's loan. You don't always have to be a physician to get this type of loan. But what it allows you to do is to put 0% down and have 0 PMI mortgage insurance, primary mortgage insurance, okay? So this is a very good loan, and typically these loan options, they have the lowest interest rates available based on your credit score. If you have good credit score, you'll have a really good deal versus going to a regular conventional or FHA. They'll typically give you a good deal. So you can put 0% down, 0 PMI. Of course, your mortgage will be a little bit higher, but now if you want to remodel your home and you have a limited budget, like I did when I bought this house, then you can have some cash available to remodel and do other things, okay, or just have reserves. So another primary home loan that's gonna allow you to put 0% down is the VA loan. Guys, the VA loan is one of the best deals, if not the best loan you can get. Okay, the US really takes care of its service members. So if you served in the United States military, you most likely, most definitely qualify for the VA loan. I've never gotten this loan option before. This is why I said most likely. So you may want to check with, whoever you need to check with to figure out if you qualify. But it's also a really good deal. You can put up to 0% down and you'll have the lowest interest rate available on the market at the time you're purchasing the house. Really good loan option, okay? Another loan option is conventional. Conventional for a primary, you can do down to 5%, up to whatever you want. You could pay, of course, the bank won't land on 20,000. Let's say you wanted to put 380 cash. They're not gonna land you a conventional on 20 grand. So you could put whatever amount of down payment you want, but the bank will let you go down to 5%, okay? So on a $400,000 house, you can put 20 grand down, just about 5%, and then borrow 380 from the bank with a conventional. And those banks are pretty much any bank. You can go to Chase Bank, you can go to your local bank, and you ask them for a conventional mortgage and see if you qualify. Of course, they're gonna want you to have, they're gonna want you to qualify in terms of your credit. They're gonna want to see your debt to income ratio qualifies. And as long as you qualify for the bank, generally speaking, most banks who originate mortgages, you will be able to get a 5% conventional loan. The third one, USDA loans. So USDA is also a loan, government-backed loan that allows you to buy a house with 0% down based on whether or not you qualify and based on the location of the property. Not every property will qualify for this type of loan. And you may also not pay any mortgage insurance on that loan. So those are the three best options for you. If you don't have a lot of down payment, to put less than 20% down on a primary. So it's going to be your VA loan, your USDA loan, your doctor's loan, your FHA 3.5% down. All of those will help you get in a primary residence. So now let's talk about secondary homes. So let's say you want to buy a secondary home in Hawaii, okay? But you're not gonna be there all the time, so you want to also use it as Airbnb when you're not there to offset the cost of the mortgage. Because let's say, like me, you live in Florida, okay? So you don't want to pay 2 full mortgages and leave a house empty while you're here in Florida. So you want to Airbnb it. Well, if you go to the bank and you tell them that, they're gonna say, okay, you need an investment loan. And then they're gonna say investment loans are 20 to 25% down. Now, if you were, Hawaii, as you know, is expensive. If you were buying a house in Hawaii for $1 million, 25% looks a lot like $250,000, $250,000. Most of us don't have that type of money just laying around. So how do you get into that house? How do you get that secondary home and make it pay for itself? Okay, so you have to get what's called a secondary home loan. Pretty much what it sounds like. Instead of wording it as an investment property, you have to tell them you're looking to get a secondary home loan. And all of a sudden, instead of putting 25% down or 20% down, based on the institution, it varies a little bit. Some will say 25, some will say 20. Now you can put 10% down. And now your $1 million home purchase in Hawaii, you only have to put 100 grand down versus 2 to 250. You just saved yourself $100 to $150,000, right? You didn't save yourself per se because you're running into an issue. You have to pay PMI. Mortgage insurance, if you put less than 20% down on a vacation home or secondary home loan, you have to pay mortgage insurance. But if you're planning on using this home as Airbnb or some sort of rental when you're not in it, the mortgage insurance, who cares? You know, the tenants are gonna pay for it, right? Or the Airbnb guest. As long as your mortgage is covered on your secondary home note, you may not care about the mortgage insurance, and so that is a way to get that secondary home without using all of your cash or without having to pay for it cash, which I would never advise, by the way. Even if you had $1 million laying around, I personally wouldn't buy a house cash for $1 million unless it was super undervalued, really good deal, and I had the money and I had reserves. A lot of stars would have to align for me to buy a house cash. Now, when I first started real estate, I bought a couple houses cash because those houses were too cheap to qualify for mortgages, which is why I did it. But if you're buying a secondary home, $1 million, don't do it cash. You're saving yourself 6% interest. There's many other investments you can put your cash in that gives you well over 6%. So that's just me. Talk to your financial advisor to do what makes sense for you. Okay, so secondary home loan, 10% down versus investment property, 20 to 25% down. So word it correctly and the bank will give you the correct loan type. Okay, now vacation home. So this is very similar to secondary home loan, right? If you're looking to get a vacation loan, some banks may qualify that as an investment property and they may require you to put 20% down. So just tell them your vacation home will be your secondary home. That's kind of how you bypass that. And then most banks will require you, okay, you just have to put 10% down. Now, this is the most expensive way to get a house, guys. This is the investment property, okay? If you get a house as an investment, right, an investment loan, most banks, it's gonna be 20 to 25% down. Plus, there's gonna be fees. Those are the most expensive loans because some of them, they charge points, you know, meaning it could be a 1%, it could be 1.5. The interest rate on the loan is higher, plus you're gonna pay points, meaning fees at closing, okay? So those are the most expensive loan types you can get. This is why some people do what's called house hacking. House hacking is pretty much buying a primary residence, FHA, 3.5% down, right? You live in it for 1 year because that's the government requirement for you to live in one. If it's a multifamily, live in one side, you know, for 1 year. You want to make sure you do that. They can check, and you don't want to commit mortgage fraud, right? So you live in it for 1 year. Then you find, after the year, you find another property, you move into the next property, you get an FHA loan, but you refinance the old one, if interest rate allows, into a conventional mortgage, because you can only hold one FHA loan at a time. Unless there's some extenuating circumstances, if you change job, out of state, blah, blah, blah. Typically, only one FHA loan for one person. This is why they advise a lot of people before they get married, the best thing you can do is that you each use your FHA loans. But you keep doing that over and over, and you're able to get into accumulate multiple properties with minimal down payment. So you get into one, then you move into another one, then you move into another one. And even if you can't do the second one FHA, you could do 5% conventional in the second one, right? Until you can refinance your FHA into a conventional. If you can't, then the third one, 5% conventional as primary, and you keep going from primary to primary every year. And in 10 years, you have 10 investment properties that you all got at, 5% down primaries, right? This is how a lot of people are able to accumulate a lot of properties without spending a lot of cash. So to do real estate, you're either going to spend a lot of time or a lot of money, okay, or both. usually some things gotta give, okay? Usually you can't scale real estate super fast without either spending a lot of time or a lot of money or both. So those are the loan types, guys. Four main loan types. Within the primary are the specialty loans we discussed, which are your USDA loan, your VA loan if you were in the military, if you are in the military, your doctor's loan, if you're a physician, or if you're a pharmacist, any sort of high, mid-level provider. Again, each mortgage company will classify who, different professions differently. Will classify maybe a nurse can qualify for it. Maybe you need to be any sort of doctorate. Usually the credit unions is your best place to start. You'll check with them, see if you qualify. If you're a pharmacist, if you're a nurse practitioner, if you're a PA, see if you qualify. Typically every physician will qualify, but if you're a different profession, just check and see if you qualify. So those are the loan types. It's very important, guys, that you use the correct loan structure for the correct situation, okay? If you don't, you can end up paying unnecessary fees and have too much of your money locked into a house. Okay guys, so it's very important that you use the correct loan structure for the correct house, okay? You don't want to use your doctor's loan, if you qualify for that, on a $100,000 investment property. Why? Because you can easily come up with $5,000. I'm assuming you can easily come up with $5,000 and get that $100,000 property conventional as a primary if you're gonna live in it. You should reserve your 0% down, your 3.5%, your 5% for properties that you really want, that are a little bit expensive, not in terms of the value, but in terms of the purchasing price versus your reserves. Okay, let's say you have your money in the stock market. Currently the market is at all-time highs. Maybe you don't want to sell your stocks and take a tax hit, and you want to put as little down as possible. So those are your options. Okay guys, if you got any sort of value out of this video, please click the like button, subscribe to the channel, leave a comment below. Let me know what you think. What type of loan did you use to purchase your house? And see you next time.